People are always asking me, why are you investing in these lower income areas like Joburg, CBD, Hillbrow, Berea? Isn't it risky? Now, unfortunately, risk and reward are two sides of the same coin. You can't have a good return without taking some level of risk. If you wanted to avoid all risk, put your money in the bank where you're not getting performance above inflation, or put your money under a mattress and hope no one breaks in and steals it. But then again, your money is not working at all, and inflation is going to erode your money. So if you want to avoid all risk, you'll also end up avoiding all returns. Now, investing in areas like behind me, Joburg CBD, areas like Berea and Hillbrow come with a risk premium. They also come with a return premium. But what most people don't understand is that the risk is not necessarily the tenants. Yes, tenants are in the lower income space tend to be a little bit more difficult to manage. And sometimes there's a little bit more delinquent behavior or non-payment, and you have to do evictions and that kind of stuff. That's pretty normal. But the biggest risk by far is buying into a delinquent body corporate. Now, what is a body corporate? A body corporate, like in this building here, there is a body corporate that is managing the outside of this building. So you've got tenants inside each unit, and you've got landlords that own each sectional title. And then you've got the landlords that are paying levies. Levies are paid to this body corporate so that the body corporate can manage the shared services. So they manage and pay for the security guard, for the outside of the building so that it's painted and cleaned and kept up to date, and for the lifts to be repaired and replaced. Now, even if you've got the best unit in this block of flats and you've got the best tenant, if your body corporate is delinquent or corrupt, you're screwed. Eventually, your asset is going to turn into a liability and you're going to want to sell. So what does it mean if a body corporate is delinquent? Well, it could mean many things. Number one, they might not be maintaining the property properly. So they might not be maintaining the lifts or cleaning the property or maintaining the general infrastructure of the property. Another thing is that they could potentially stop paying the electricity. Now remember, the body corporate is paying the municipality for the electricity, the water, the sewage, the refuse. If they stop paying that, even if you as the landlord, if you and I are the landlords of these units and we're making our diligent payment, but the body corporate is not paying, the municipality is going to switch off access to the building. There'll be no power and no water. So your biggest risk in investing in this area is not the tenants. You can do good vetting. There's eviction options for you to follow, and there's tremendous demand. So even if you have to get rid of a tenant once or twice, you're going to be able to replace them. That's not the biggest risk. The biggest thing that'll keep you up at night is making sure you buy into the right building that isn't corrupt. And that's what I'm going to share with you in this video, how you can review the financial statements of a body corporate to make sure you're buying into the right building. I educate people to reach financial freedom through property through cash flow positive investments, specializing in the low income multi-let residential market. Now, as part of my coaching program, I always help my students review their first set of financials because it can be quite overwhelming, especially if you're not financially inclined or if you've never been taught how to read one of these documents. So if you want to get involved with me and join my coaching program where I hold your hand through the process of buying your first property, I help you sign the OTP to review the due diligence to make sure the numbers stack, and I introduce you to all the teams, tools, and templates that I've built over the years to make sure your first investment is your best investment. So let's look at two sets of financials. I'm going to show you this is from a student of mine who recently made a purchase, and I'm going to show you a good set of financials. So this is the building she brought to me, and I gave her the green light. And then I had another student come, and they showed me a bad set of financials, and we ended up deciding to decline moving forward with the offer because the financials look so bad. So we're going to look at a good set of financials first, then we're going to look at a bad set of financials. So this is the financial set of a company or a body corporate called Orlando Court or Land Court. And you can see here that the financial statements are from 30th September 2022. You obviously want to try and get the latest set of financials. It's not always possible. And if there are no financial statements, if the agent says to you, we don't have that kind of thing with this building, that should give you massive red flags, because every building that is a sectional scheme by the Sectional Scheme Act has to have a set of financials. Now, the beginning part of every financial is a bit of general information. You can usually just gloss over this. It's not really important. Then you can see the index, so where all the different specific things are listed. Then we've got some more some more legal jargon. I usually just skip through this. Okay, so here we've got our first statement of financial position. Okay, and we can see two sets of years here. We can see our 2022 and our 2021. We've got our assets. Assets are good things. Assets are like property or equipment or something that has value. And then you have liabilities. That's like debt or things that you owe. You owe money to somebody would be a liability. So you can see here that they've got current assets. They've got levies in arrears. So landlords owe them money, which is why it's an asset. You've got accounts receivable, deposits, and cash equivalents. So we have in 2022 an asset base of 330,000 Rand. Then we have equities and liabilities. So the equity section is here, owners, funds, and reserve. A reserve fund is always good to see. It's good that you have a reserve fund because when you have to replace the lift of one of these buildings, you don't want to necessarily charge a special levy to your landlords. You want to be able to just tap into that reserve. So this is already a very good sign for me. I'll put a tick there. And then administrative fund. And then liabilities, you can see levies in advance and current liabilities very, very low. So this is already good. Their assets outweigh their liabilities, meaning they're liquid. If it was the reverse, if they owed more money than they had in receivables, that means they're overgeared. They don't have enough money. If they had to sell all their assets, they wouldn't be able to cover their debt and they'd be stuck still owing money. So this is a good sign. Then we can move on to the levy statement. You can see that the revenue line here, levy income, that's how body corporates survive. That's their source of revenue, is each landlord that owns each one of those sectional title has to pay an agreed amount per month. So they're generating 256. And I like to look at year on year, so sometimes I can look at 4 or 5 annual financial statements to see trends. But what I can see here is that in 2021, they received 250 and now they're receiving 256. That's a pretty good collection rate. That means that over the 2 years that I've got data, they're collecting more or less the same level of revenue. Their expenses in 2021 were much higher than they were in 2022. Again, that's a good sign. That means that they've reduced their operating expense. But I'd probably go back to the body corporate and ask them, what was this 324? Why was it so high? They probably didn't collect as much, or there's probably some sort of narrative behind that. And then we have changes in reserves. So as I mentioned, you've got a reserve fund, some money set aside in a kitty for, a rainy day. And you can just see that in 2020, they had 76,000. Then in 2021, they had 110,000. And now they have 146,000. So what that's telling me is that they are continually increasing their reserve. They're putting more and more money aside in the event that something goes wrong. So another very good sign. So we've got good collections. Well, we've got first good assets to liability ratio. We have good revenue collection and we have good reserve fund in place. So there's some good ticks here that we're already picking up on. Now let's get into a little bit more of the detail. So here we've got levies in arrears. So what is owed by the landlords? You can see that there is 2,000 Rand in current, 30 days of 1,000, and in 60 or 90 days, there's 500 Rand. So for the most part, landlords are coming to the party. They're paying their levies on time. And in 2021, they had 40,000 outstanding. Now they got 4,000 outstanding, which means that they are collecting more from the landlords and the landlords are becoming more and more compliant. Another tick. And we've got insurance. Good that they have insurance. Buildings that have or don't have insurance will not get finance from the bank. So that's, I guess, a small little half tick. And then we've already spoken about the reserve, the insurance policy. So this is great to see what kind of insurance they have. You could go to that step and ask for an example, ask for the policy and then go and see exactly what's covered. Is the geyser covered or is that on the landlord's responsibility? And then here we have a detailed levy statement. So we're seeing their revenue and their expenses. Remember, in 2021, we saw a big expense cost of 324,000. So here's the detail. So looking here, we can see the main charges were insurance, which was 41,000, and then municipal charges, if I'm reading that right. So that's where a big part of the cost was, and repairs and maintenance. So essentially what's happened is that this company has reduced its insurance by almost half, and the municipal charges have gone down drastically, and the repairs and maintenance have gone down. So these are all good signs for me. This means that they're just managing it a little bit better, and they're being diligent about it. So I'm going to give 3 little ticks here. Revenue collection, as we spoke about, the same. They're collecting the same amount year on year, which is fantastic. We've got the ombuds service. Fantastic. If you've got an ombudsman, that means that if the body corporate becomes delinquent, you've got a institution to go and lay a complaint with. That's what the ombuds service is. And essentially what we have here is a bit of a loss in year 2021. That's not really uncommon, and that's kind of expected. So, they lost 61,000 in year 2021, but they had a massive renovation bill. So they probably did the lifts and did some big work, and now they're at a profitable state. So all in all, assets outweigh liabilities and it's profitable. The income outweighs the expenses. From what I'm seeing here, this is a very well-run building. And as long as you stay on top of the trustees and the body corporate and make sure that it continues to perform this way, you're very risk-free investing in this building. I'm going to give it a big tick for let's do it. Now to the more fun annual financial statement. I'm sure the one that you were more interested in seeing, the one where I gave my student the advice to not proceed because the financials looked pretty shoddy. So here is the body corporate of Chantilly, and this is year ending May 2022. So you'll see once you've done a couple of these financial statements, you'll see they're all kind of structured the same way, and you'll start to pick up on what's important to look at. So it's maybe overwhelming this first time that you're looking at it, but as you do a couple more of these, you'll see it's actually not that hard. So they've got the same thing. They've got the index. They've got all this legal spiel about, this is independent and blah, 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 blah. Always ignore all of this. So again, we've got the balance sheet. So this is showing us assets versus liabilities. If you have more liabilities than you have assets, it means you owe more than you have coming in. That's not a good place to be. So we have a total assets here of 187, and in 2021 we had 207. So the assets have gone down slightly. You've got levies in arrears. Look at how high this number is. 126,000 in arrears. At least it's better than the year before. So there has been some improvement. And then we go to the owner's funds, the reserves. They're at a negative. They have a negative administrative fund of 555,000. Where do you think that money is going to come from? If their only real revenue is levies that they charge into the landlord, there's going to be some sort of special levy applied to the landlords to be able to recover this loss. And they went from 130,000 Rand in arrears to 555. So that's just showing me delinquent behavior or mismanagement. That's not a good sign. And then their current liabilities, accounts payable of 740,000. As we go down to the bottom, we'll see what accounts they are owing. I'm going to probably assume that it's maybe municipal accounts. So we basically have a situation where the assets are not big enough to cover the liabilities. So if they run out of business, they can't cover their debts. This is already a very, very bad sign. Let's change our color and show a big red. This is not good. Let's move on to the levy statement. Now we've got our revenue and we've got our expenses. So our revenue line is here in green and our expenses line is here in red. Okay. So starting with the revenue, we can see that revenue collection over the 2 years was pretty much the same. So that's not a bad sign. They've also got an ombudsman service. So that's a good sign. They're at least subscribed to that. And they're essentially maintaining the same level of revenue, 196 to 207. Not terrible. I would give this probably a half tick. Then we go on to our expenses line. Now, here we go. Municipal charges of 555,000 Rand. How does that go from 200,000 to 555,000? Now, it could be potentially that the municipality has incorrectly invoiced the body corporate. That's maybe some, further due diligence that we could do after speaking to the body corporate and to the trustees. Or it could be that, this body corporate has just not been paying sufficiently. And now, there's arrears are charged and interest is charged. I'm not exactly sure what's happening here, but this is not a good sign. Other than that, the expenses don't look terrible. That's the main outlier. And that's why expenses have gone from 240 to 630. And here you can see, look at the loss in revenue. No business. You don't want to invest in any business where the expenses are greater than the revenue, because at some point, that company is going to fail. And here we have 207,000 in revenue trying to cover 600,000 in expenses, meaning there's a loss of 424. Where's the loss going to be accrued, or where's it going to be recovered? From you and I as the landlords. That's the only way that this company generates revenue. So we're going to have to fork out more in special levies. So all in all, another bad sign. Now we've got changes in reserves. So remember, the previous one had good reserves, meaning they had a positive kitty they could tap into. Here we've got a negative kitty. The only way they're going to recover this is by charging more levies. So another big cross. And then we'll see they've got levies in arrears. So this is a lot worse than our previous building. You can see that there's almost 100,000 Rand of levies in 120 days plus. So what this is telling me is that the body corporate is not chasing landlords effectively. The landlords are not really paying for the levies. That's why the reserve is so low. So the landlords are kind of delinquent. The body corporate's kind of delinquent. It's probably that no one really cares enough to make this building a success. So for you to go and buy in, and even if you pay your levies and you've got the best tenant and you do everything right, you're still going to end up with a liability at the end of the day. So another negative. Renovations, they only put 2,000 Rand into repairs and maintenance in 2021. Nah. I've got a lot of small buildings, 6, 10, 20 units, and we put 150 to 200,000 Rand per annum into these buildings to make sure they're maintained well, because good buildings attract good quality tenants. So very bad sign here. I mean, you can see the red flags are everywhere. Assets are less than liabilities. Income is less than expenses. They're not chasing arrears. They're not managing this well. This would be a hell no. So in summary, it's really simple. You're not just buying a unit or buying a tenant, you're buying into the building. And if the building's financial statements do not spark confidence, then you have to move on. So as part of your diligence process, before you proceed with even taking your offer to the bank to raise finance, make sure you've reviewed the latest financial statements of the building. As another side benefit, when you do apply for finance, the bank will also do their own due diligence. And if they see that the building is not insured or not in good financial health, they'll probably decline to loan to you. So there is that extra safeguard, but make sure that you're doing your own due diligence, that you understand the risk premium that goes with any building so that you can justify the return. I hope you enjoyed this video. Give it a thumbs up and don't forget to subscribe. Property investing can be scary, and sometimes it's nice to have an experienced, seasoned investor look over your deals. That's why I've created my property coaching program, where I sit with you on a one-to-one basis and help you through the process of buying your first investment property. If this sounds interesting, book a free 15-minute call with me and we'll see if it's the right fit.